business decisions are reached, they're basically reached on an interest rate basis. All the tools that you've acquired so far, chapters 2 and 3 and 4, and especially chapter 9 on time value of money, those are the tools that you need to complete the business decision. Well, chapter 11 and 12 give you the decision-making mechanism. One of those would be the cost of capital. So when we look at the weighted average cost of capital, which is simply a geometric average or a weighted average of the various sources of funding, which can include debt, preferred stock, or common stock, those are combined together to give the cost of the firm's obtaining capital to fund the projects. Now, typically, a large firm will have some sort of a balance between debt, preferred stock, and common, and that tends to remain fairly constant regardless of the growth or contraction of the firm. We call that, you see down at the bottom, their capital structure, which is basically their debt to equity ratio, or the portion of the firm that is financed by debt and the portion of the firm that is financed by the issuance of stock to stockholders, either preferred or common. And that sort of forms the capital structure of the firm. Now, the PowerPoint that's available gives you a pretty good example of the weighted average cost of capital. But I think some of you might be confused on how to go about determining the cost of debt, or the cost of preferred stock, or the cost of common stock. Well, the tools are in the Chapter 11 PowerPoint, but we'll take just a quick look at a couple of them as we go along. Now, one of the most important elements is that thing next to the bottom called CAPM. That is the Capital Asset Pricing Model, which utilizes the firm's structure within the overall market and uses a concept called beta, which is a risk assessment measure to help complete the risk assessment that goes into it. So let's take a quick look, and I'm going to remind you about one very important equation. So let me get around here to this chalkboard, and we'll see what we've got. Cost of capital. Now, we all recall that the nominal interest rate is equal to the real interest rate plus an inflation premium plus the risk premium. And all of these are important elements for determining the interest or the cost of capital. But this by itself doesn't give us much because, well, I need to embrace the truth of the company structure within the cost of capital computation. So, given that a firm has some weighted average cost of capital, we have a project that we want to do, and we predict the project will have a yield equal to, say, Y. Well, the decision is very simple. If Y is equal to or greater than the cost of doing that project, it's a good one. It's a good project. In other words, I'm going to make more money out of that project than it costs me. Good. On the other hand, if the yield of the project is less than it costs me to do that project, that's not good. So I won't do a project. That, folks, is the fundamental decision tool for financial decision making. If I get more out of it than it costs me, good. If I get less, not good. And we're going to look at Chapter 11 now to find out how we go about computing some of these costs. We're going to look at the costs, and then in Chapter 12, which I think will be a subsequent video, we will go ahead and look at how we figure out a little bit of the why. So, we've got three methods. Let's first look at debt. Debt, of course, you know, is a tax deduction. Recall your who can spell deduction these days? Obviously, I'm not doing very good, but it's got a tax advantage for us. And if you recall your income statement, interest is taken off of the firm's income before they pay taxes. So debt is a good instrument because it provides a tax advantage. So if I look at the cost of my debt, then the real cost of the debt is 1 minus the tax rate. So the cost of debt might be the coupon payment interest times 1 minus the tax rate. That's one of the elements that comes into play. But we're not going to worry about that. We're just going to come up and say, I've got a cost of debt. And the cost of debt is determined based on your chapter 10 determination on what it really costs you to give that debt out. Okay, preferred stock. The cost of preferred stock, cost of preferred stock, K sub P, is equal to the dividend payment divided by the price of the stock minus the flotation. That's what's given in your book. Now, this flotation cost is something interesting because most companies don't issue their preferred stock or anything else for that matter by themselves. They usually have an investment bank issue that for them. So the flotation cost is simply the service fee that you pay to the investment bank to get that particular issue completed. So we have the price of the stock that's issued less the flotation cost, and that measures the net amount to the company. The dividend is the basis of issuing that stock. That's the enticement to the investors to give up their money in exchange for the stock. So therefore, the cost of that stock is the dividend I have to pay out of it, some portion of what I get out of the stock. And that's the cost of the preferred stock. Okay, and let's look at common stock. Now, in chapter 10, we looked at this very nice little equation that the price of stock today is equal to the next dividend divided by the cost of that yield of that stock minus the growth rate. Well, here we go. We're just going to simply solve for that, and we get K sub E equals the dividend divided by the price plus the dividend growth rate. And once again, if I'm going to issue new stock, I have a flotation cost. And if I don't have a flotation cost because I have existing stock already that I'm holding in reserve, I usually, if I'm a corporation, I'll usually have some stock held in reserve that I can then, I've already paid for it, and so I ignore the flotation costs on that stuff. But, you know, if I want to issue a new round of stock, I have to pay the flotation cost. Okay, so we have our mechanism now of determining the cost of issuing debt, the cost of issuing preferred stock, and the cost of issuing common stock. So, you know, that gets pretty simple. That's just a matter of working the arithmetic. But let's think about this thing called CAPM. Now, you see the equation here. KJ, is the symbology used in your book, equals some risk-free rate plus beta times the return of the market minus the risk-free rate. Now, this is what we call the market premium. I could invest all my money in U.S. Treasuries and it eliminates all risk. At least that's the financial theoretical statement. The market is hopefully going to give me better because I'm getting a little risk. So this measures basically the market risk. And beta is a factor determined, and you can see the development in your textbook. Beta is determined about this particular company's risk. So it's a measure of the company's risk relative to the market. This also gives us the equivalent of K sub E through a different mechanism that will give us the cost of equity with market risk of that particular firm taken into account. Now, beta is an interesting element and has some implications. If beta equals 1, that means the company's risk is the same as the market. Okay? If beta is greater than 1, the risk is greater than the market. And if beta is less than 1, the risk is less than the market. Okay? Now, less than 1 also includes negative, and a negative beta would imply that the particular element or the particular instrument being measured actually is not correlated with market. If the market goes up, this stock will go down, and similarly, if the market goes down, this stock will go up. Many people say use gold as an example. However, today that's not really working out. Gold's going up, the market's going up. Where's the lack of correlation between those two? It's hard to find a negative beta stock. So if we look at CAPM, we can determine based on the market performance how that works. And there is an example. Well, I guess there is an example in the PowerPoint, but there's a good example in the textbook. Now, I think what you need to remember out of this chapter is that funds will be allocated to projects based on their relative standing to the weighted average cost of capital. I can compute that using the general equation where the weighted average cost of capital is equal to the sum of the weight of a particular element times its cost. Let's call that K sub I. That can be either debt, preferred, or common stock, and the weight is simply the proportion of the total. For example, let's say a company has $1 million capital structure, and of that $1 million, 500,000 is debt, 10,000 or 100,000 is preferred, and 400,000 is equity. Well, we would see that their capital structure, W for debt would be 0.5, W for preferred would be 0.1, and W for common would be 0.4. And depending on what the various costs are that I determine, I would simply find my weighted average cost of capital by multiplying 0.5 times the cost of debt plus 0.1 times the cost of preferred plus 0.4 times the cost of common stock. That gives me a weighted cost of capital, which gives me my decision point on how to decide is a project good. Now, the figure in your PowerPoint that talks about the 8 projects for use for capital funds shows you an example where projects, ranking them in order, projects A, B, C, D, and E all have projected yields above the weighted average cost of capital. And projects F, G, and H are below the yield. So I would accept projects A, B, C, D, and E, and I would reject projects F,